Welcome to Newsbeacon, your trusted source for breaking headlines, global insights, and sharp analysis from around the world. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss an update. The United States and Canada share more than a border. They share deep economic ties, but their fiscal paths are diverging. As of late 2025, the U.S. faces a national debt exceeding $37 trillion and a persistent trade deficit. Canada, meanwhile, maintains a much smaller debt and a trade surplus, selling more to the world than it buys. These differences shape the daily lives of citizens, influencing interest rates, job opportunities, and the cost of living. Understanding this growing gap is crucial to predicting where these two economic giants are headed. In the next sections, we'll break down what America's debt and trade deficit mean, and how Canada's different choices have led to greater stability. By comparing their paths, we'll uncover the challenges and lessons each country offers the other. Let's dive into this tale of two economies. $37 trillion, America's national debt, defies comprehension. This staggering sum is the result of decades of borrowing to cover budget deficits, driven by tax cuts, wars, economic crises, and expanding social programs. The debt has soared by $4 trillion in just 2 years, and now interest payments alone consume hundreds of billions annually, crowding out spending on education and infrastructure. High debt means higher interest rates for everyone. Mortgages, car loans, and business borrowing all become more expensive. If investors lose confidence, borrowing costs could spike, slowing the entire economy. The US dollar's global status has allowed this borrowing, but it's not without risk. Ultimately, the $37 trillion debt is a warning sign, one that threatens America's long-term fiscal health and stability. The choices made now will shape the nation's economic future. The question is, how long can this path continue? The answer will affect every American. The U.S. has run a massive trade deficit for decades, importing far more than it exports. This means that, year after year, the country buys more goods and services from abroad than it sells to other nations. The scale of this imbalance is staggering, and it's a defining feature of the modern American economy. Each month, billions more leave the country than come in, adding up to nearly $1 trillion a year. This outflow of money doesn't just vanish, it circulates globally, often returning as foreign investment or loans, but it also means the U.S. is constantly in debt to the rest of the world. This is fueled by Americans' appetite for affordable goods made overseas and a strong dollar that makes imports cheaper. From smartphones to clothing, everyday products are often sourced from countries where labor and production costs are lower, making them more accessible to U.S. consumers. While consumers benefit from lower prices, the long-term cost has been a decline in manufacturing jobs and weakened local industries. Many once thriving factories have closed, leaving behind empty buildings and communities searching for new sources of employment. Critics say this hollowing out has devastated communities once built on factory work. The loss of these jobs has ripple effects impacting local businesses, schools, and the social fabric of entire regions. Yet, the trade deficit also signals a wealthy nation able to buy from the world, and it helps keep inflation in check. Access to inexpensive imports means American families can stretch their dollars further, especially during tough economic times. The challenge is sustainability. An endless deficit means dependency on foreign capital and vulnerability to global shocks. If foreign investors lose confidence, the U.S. could face higher borrowing costs or even a financial crisis. The pandemic exposed just how fragile these supply chains can be. Disruptions led to shortages, delays, and a new awareness of how interconnected and vulnerable the global trading system really is. America's trade imbalance is both a symptom and a cause of deeper economic issues. It reflects choices about what the nation produces, consumes, and values, and it shapes the country's future prospects. Finding a better balance is essential for future prosperity. This could mean investing in new industries, supporting innovation, and rebuilding the manufacturing base to create more resilient jobs. The question remains, can the U.S. shift from consumption to production? Can it once again become a nation that makes as much as it buys and exports its innovations to the world? The answer will define its economic resilience. The choices made today will echo for generations, shaping the strength and stability of the American economy. The stakes couldn't be higher. The future of American prosperity depends on how the nation responds to the challenge of its trade deficit. Canada's story is the opposite. Recent years have seen consistent trade surpluses. The country exports more than it imports thanks to its vast natural resources: oil, gas, minerals, lumber, and agricultural products. High global commodity prices have boosted Canada's export revenues, injecting foreign money into the economy and supporting jobs. This surplus strengthens the Canadian dollar and funds public services. But there's a catch. Canada's reliance on commodities makes it vulnerable to price swings and global slowdowns. A drop in oil or mineral prices could quickly erase the surplus. The challenge is to diversify beyond resources, building up manufacturing and technology sectors for a more resilient future. Canada's trade success is real, but it's not guaranteed. The next chapter depends on innovation and adaptability. The world is watching. Canada's national debt is about $900 billion US, a fraction of America's, and less than half its GDP. This relatively modest figure is the result of decades of careful management and a national commitment to fiscal responsibility. While the US debt continues to climb, Canada's approach has been to keep borrowing in check, aiming for long-term stability rather than short-term gains. This manageable debt is the result of hard lessons from the 1990s, when a crisis forced deep spending cuts and a new culture of fiscal discipline. Back then, ballooning deficits threatened Canada's credit rating and international reputation, prompting a dramatic shift in how the government handled its finances. The experience left a lasting mark on policymakers and the public alike. Today there's broad political consensus on keeping debt in check, even as deficit spending occurs during downturns. Across party lines, leaders generally agree that fiscal prudence is essential for economic health, and that borrowing should be strategic and temporary, not a permanent fixture of government policy. Lower debt means less money spent on interest and more available for healthcare, education, and infrastructure. This allows Canada to invest in its people and its future, supporting a high quality of life and robust public services that Canadians value deeply. It also gives Canada flexibility to respond to future crises without risking fiscal stability. When emergencies strike, whether economic, environmental, or health-related, the government can act quickly, knowing it has financial room to maneuver. Still, debates continue over whether fiscal restraint has led to underinvestment in areas like defense or infrastructure. Some argue that being too cautious can mean missing opportunities to modernize or strengthen the country in key areas, sparking ongoing discussions about the right balance. The government's 2025 budget aims to slowly reduce the debt-to-GDP ratio, maintaining a sustainable path. This gradual approach is designed to protect essential services while ensuring that Canada's finances remain on solid ground for generations to come. Canada isn't immune to debt challenges, but its disciplined approach stands in sharp contrast to its southern neighbor. The differences in policy and political culture are stark, and they shape each country's economic future in profound ways. The lesson: fiscal prudence pays off. By learning from the past and planning for the future, Canada has built a reputation for stability and resilience in a world of uncertainty. Stability is a choice, not an accident. It's the product of deliberate decisions, careful planning, and a willingness to make tough calls when necessary. The question is whether Canada can maintain this discipline as pressures mount. Only time will tell if the country can continue to balance its ambitions with its commitment to fiscal responsibility. America and Canada's economic differences stem from their political cultures. In the U.S., sharp ideological divides and frequent policy swings make fiscal discipline elusive. Tax cuts and new spending often happen without matching offsets, fueling structural deficits. The dollar's reserve status lets the U.S. borrow cheaply, but also breeds complacency. In Canada, the memory of past debt crises drives a more consensus-based, cautious approach. The parliamentary system allows for steadier, long-term fiscal planning. Without a global reserve currency, Canada faces immediate market discipline if debt grows too fast. This forces greater responsibility and a focus on sustainable debt-to-GDP ratios. Each country's system shapes its economic destiny. The contrast is clear short-term politics versus long-term planning. The results speak for themselves. National debt and trade balances aren't just numbers, they hit home. In the U.S., massive debt means higher interest rates for mortgages, car loans, and student debt, squeezing family budgets and small businesses. The trade deficit brings cheap goods, but at the cost of lost manufacturing jobs and struggling communities. In Canada, lower debt helps keep borrowing costs stable, while a trade surplus supports jobs and funds public services. But reliance on commodities means families can be hit hard by global price drops. These economic forces shape daily life, what you pay, what you earn, and the opportunities available. The choices governments make ripple through every household. Understanding these impacts is key to making informed decisions. The economy isn't abstract, it's personal. The U.S. can draw key lessons from Canada's fiscal journey. Building political consensus around fiscal responsibility is crucial. Canada's 1990s reforms show tough choices pay off. Setting a clear fiscal anchor like a debt-to-GDP target helps discipline spending and guides policy. The U.S. could also focus on boosting exports in sectors where it has an edge, investing in infrastructure and education to close the trade gap. Canada's public acceptance that services must be paid for through taxes offers a model for honest debate. The U.S. needs a more realistic conversation about the trade-offs between taxes, spending, and debt. Fiscal health requires discipline, transparency, and long-term thinking. The path forward is challenging, but the lessons are clear. It's time to learn from the neighbor to the north. Canada, too, can learn from the U.S., especially its economic dynamism and ambition. The American spirit of entrepreneurship and willingness to take risks has fueled decades of growth and innovation, making the U.S. a global leader in many industries. America's diverse, innovative private sector and risk-taking culture have created world-leading industries. From Silicon Valley's tech giants to the manufacturing powerhouses of the Midwest, the U.S. has shown how embracing new ideas and investing in talent can transform an economy. Canada's economy, still reliant on resources, needs to diversify and foster more competitive, less regulated environments for new businesses. By encouraging entrepreneurship and reducing red tape, Canada can unlock new opportunities beyond its traditional sectors. U.S. companies think globally from day one. Canadian firms could benefit from a bolder, international mindset. Expanding their reach and building connections abroad will help Canadian businesses grow and compete on the world stage. Policies that help Canadian businesses scale and access global markets are essential. Supporting innovation, investing in skills, and opening doors to international trade will strengthen Canada's economic future. The U.S. also shows the value of a flexible labor market. Canada could reduce internal barriers to make its economy more dynamic. Making it easier for workers and businesses to adapt will help Canada respond to changing global trends. Embracing innovation, ambition, and mobility will help Canada weather future shocks. By fostering a culture that rewards creativity and resilience, Canada can build a stronger, more adaptable economy. Each country holds up a mirror to the other, offering valuable lessons and inspiration. The close relationship between the U.S. and Canada is a unique advantage, providing opportunities for collaboration and shared growth. The exchange of ideas and lessons is vital for both. By learning from each other's successes and challenges, both nations can continue to thrive in an ever-changing world. The future depends on adaptability and learning. Those who are willing to evolve, experiment, and collaborate will shape the next era of prosperity. The story of North America's economies is still being written, with new chapters unfolding every day as both countries face new opportunities and challenges. The next chapter is up to them, and the choices they make today will define the future for generations to come.